Hey there, as a therapist in private practice, you might be wondering, should I be using an IRA to save for retirement? And that is exactly what we're going to cover in this video. Hi, my name is David Frank. I'm a financial planner and founder of Turning Point Financial Planning, where all we do is help therapists navigate every element of their financial life. And of course, one of those big elements is around retirement, and using an IRA for retirement is in many cases a great place to begin. So today we are going to talk in a little bit more detail all about that and cover the 7 things that every therapist needs to know about IRAs. Now, the IRS calls them individual retirement arrangements. Pretty much everyone else calls them individual retirement accounts. But regardless of what you call them or what you think the acronym stands for, IRAs, easy for me to say, are confusing things, but they are important too. For many therapists, easy for me to say, they're going to form the cornerstone of retirement planning. So with that in mind, I wanted to share with you the 7 things every therapist needs to know about IRAs. They'll help you decide if using an ordinary IRA is the right way for you to save for retirement. So number 1, an IRA is in fact often the easiest way to save for retirement. An ordinary IRA is the perfect way to save for retirement in many cases because it is so easy. Anyone who has earnings from a job can open and contribute to an IRA. It doesn't need to be sponsored by your business, that's your practice, and that means that there's virtually no paperwork. And despite having the lowest annual contribution limits of the many different confusing retirement plans you could choose from, you can still save quite a bit. For the year 2023, you can contribute up to $6,500 to an ordinary IRA. If you're 50 years of age or older, you can contribute an additional $1,000 for a total allowed contribution of $7,500. Note that these limits are for the year 2023, and they do typically increase every year to adjust for inflation. So if you plan to save less than that $6,500 or $7,500 this year toward retirement, there's really no need or little need to deal with a more complicated retirement plan solution. So I would say probably in most cases, you should just open that ordinary IRA and start saving. So number 2, an ordinary IRA is quite different from a SEP IRA, is different from a simple IRA. So man, this stuff does start to get confusing. So when we're thinking about those more complicated retirement plan options, and those are available options to you as a business owner, as a practice owner, the SEP IRA and the simple IRA are 2 of them. But despite having the word IRA in their names, they function quite differently than the ordinary IRAs that we're talking about in this article. SEP IRAs and simple IRAs are retirement plans which are sponsored or kind of controlled by a business. That's unlike an ordinary IRA, which is opened and controlled by an individual, which would be you in this case. So SEPs and simple IRAs, they just happen to use the IRA as the account that each employee owns. The rules which govern the SEP IRA and the simple IRA are much different and more complex than the rules we're talking about here. So I know this stuff is confusing. The important point to remember is that if you have a SEP IRA or a simple IRA, the rules that we're discussing here today and most of the rules you're going to see talked about online don't apply to you. So number 3. A Roth IRA is often a better choice than a traditional IRA, but honestly, opening either is going to be a win. So a win, easy for me to say again. So back in the land of ordinary IRAs, so not SEPs, not simples, just ordinary IRAs, you still do have 2 choices. You can open and contribute to either a traditional IRA or a Roth IRA. Which is better for you? Well, I don't know your situation, so I can't give you definitive advice here, but in many cases, a Roth IRA is going to be a better choice. The reasons I prefer the Roth IRA over a traditional IRA, and that applies to most, but certainly not all therapists, the reasons are complex and they involve a lot of nerdy finance math, but I'm not going to bore you with that today. But in general, if you're, roughly 45 years of age or younger, I would say lean toward opening a Roth IRA. And honestly, in many cases, even if you are 45 years of age or older, a Roth IRA still is going to be kind of the way that I lean. But the bottom line is don't get stuck in this decision. Funding either a Roth or a traditional IRA is a huge win. And of course, if you suspect that your situation is unique and you need individualized advice to make this decision, I'd really encourage you to seek out a qualified and licensed professional. So point number 4, an IRA is a container and it is not an investment itself. This is one of the most important things to remember about IRAs, that they are not an investment. They are not a type of an investment. Rather, they are a type of account, just like a bank account. So in other words, an IRA is a container for your investments. It's what holds your investments, but it is not the investment itself. So in fact, IRAs can contain virtually any type of investment you want. There are certain restrictions, but in general, you won't have to worry about them because if you're employing a prudent investment strategy using highly diversified, passively managed, and low-cost investment funds, those are all going to be totally fine to have in your IRA. So on that point, when you open your IRA, you will need or want to pick an investment fund. And if you're not certain what fund is right, I often recommend Vanguard Target Date Retirement Funds. Using these funds is as simple as retirement investment gets. And while it's simply not the perfect fund for everyone, it is often a pretty darn good choice. How it works is you simply pick the fund with the year closest to your expected retirement year, and the fund takes care of the rest. That's it. Other firms beside Vanguard offer these target date funds, although do be cautious. I found that many of the competitors to Vanguard have funds that have outrageous expense ratios, which you want to avoid. And that does in fact bring us to point number 5, that you should watch for hidden fees and expenses. Now, the investment world, it can be a scary place. And the thing I find most scary is all the hidden fees and expenses. And those might not seem like that big of a deal because they're usually small percentages. But if you're investing for several decades, and that typically is how I'd like you to be investing for retirement over a very long time horizon, those are going to add up and take a big bite out of money that is rightfully yours. So no matter what financial institution or professional you're working with, be sure to ask and understand the various fees, expenses, and other charges you'll be paying. That conversation, it might be a little bit awkward, but it's your money and you have the right, and that right is enshrined in federal and state law, to get honest answers about the fees and expenses you'll be getting hit with. So I mentioned Vanguard Target Date Funds just before, and you can open an IRA with Vanguard directly, and many times that is what I recommend that folks do. Now, Vanguard, they're not perfect, but I think they are among the best in the business, and they do offer some of the lowest cost, often the lowest cost investing and retirement plan options out there. So again, I can't know for sure what's right for you, but definitely at least consider Vanguard and see if they're not a good fit for your situation if you're using an IRA to save for retirement. So point number 6, you can contribute to an IRA up until tax time. So this is one of the cool things about using an IRA to save, is that you have some time flexibility. As we discussed above, the amount you can contribute to your IRA is limited each year, but you generally have up until the personal tax filing deadline to fund that amount. So what am I talking about? So for example, if you're under 50 this year, you can contribute up to $6,500 for calendar year 2023 into your IRA. But you have until the tax deadline in April of 2024 to make that decision and to actually follow through on that funding. So if you find yourself wishing you had contributed to an IRA after you've already rung in the new year, that's okay. The IRA is still an option available to you as long as you follow the income limitation rules, which we're going to talk about next. So number 7, IRA income limitations. They are important. Know the rules before you contribute. So this is going to be the most confusing bit, but don't stress. We're going to take it step by step and walk through it together. There are all kinds of income limitation rules. They get really confusing. They're all like nested and they move around and it's really tricky, but we can kind of break it down into a couple sort of, if your situation applies this way, then think about these limitations. It gets a little bit more complex though, because Roth IRAs and traditional IRAs, they have different income restrictions because, well, of course they do, just to make things more complex. So since I generally favor the Roth IRA for most folks, at least in the beginning, let's talk about the income restrictions on the Roth IRA first. Now, the Roth IRA rules around income limitations, they're reasonably straightforward. Basically, how it works is once your income hits a certain threshold, your ability to fund to the Roth IRA begins to get phased out. So that means that while you still may be able to contribute a certain amount to the Roth IRA, you're only allowed to contribute a somewhat lower amount than the total compensation limit. That's that $6,500 or $7,500 if you're over age 50. Once your income hits a second higher income threshold, then you're entirely phased out and you may not contribute to a Roth IRA whatsoever. So, all right, so here are those limitations again for the year 2023. If you're single, unmarried, your Roth IRA begins to be phased out at an income of $138,000 annually. And then your ability to fund any money to a Roth IRA is entirely eliminated at $153,000. If you're married and you file your taxes jointly, which pretty much everyone does, the Roth IRA phase out begins at $218,000 in annual income, and you're fully phased out of the Roth at $228,000 in income. So if you find yourself close to or in the range of any of these income limitations, in that case, I really encourage you to work with a tax professional, tax software, or a financial planner because the phase out math is pretty complicated. You can also use a backdoor Roth IRA strategy to get around these limitations, but that is tricky. There's even more rules involved, and I generally would advise folks to get professional guidance if they're going to go down that backdoor Roth approach. So that's it for the Roth. Let's talk about the traditional IRA income restrictions. And believe it or not, the income limitations around traditional IRAs are even a bit more confusing than those for Roth IRAs. But there is good news here. You can always contribute to a traditional IRA. However, whether that contribution is tax deductible sometimes depends on your income. I know, the rules are confusing. And what I mean by deductible is that the contribution to your traditional IRA is going to reduce your taxable income, and that results in you paying less in taxes. And so that works just like a business deduction in your practice. It reduces your taxable income. Now, you only have to worry about these income limitations for the traditional IRA if either you or your spouse has access to a retirement plan at work. Now, the word access is important. Often it doesn't matter if you or your spouse actually participates, but rather only if you had access and could have participated if you chose to. If neither you or your spouse has access to a retirement plan at work, then you can stop here, skip the rest of this video. There's no need to worry about these rules. In that case, when neither of you or your spouse have access to a retirement plan at work, your traditional IRA will almost certainly always be fully tax deductible regardless of income level. But okay, so with all that mind-numbing detail as background, here are the two circumstances where you do need to pay attention to these income limitation rules. Number one, if you're employed outside of your own private practice where you have access to a retirement plan, the deductibility of your traditional IRA contribution will begin to get phased out at certain income limits. Now, this phase-out range is going to work just like the Roth IRA phase-out ranges that we talked about above. So if you're single, unmarried, the deductibility of your traditional IRA contribution begins to be phased out at $73,000 of annual income and is fully eliminated at $83,000 of income. And again, remember, you can still contribute to the IRA. It's just that that contribution won't be tax deductible. Something you can do, but something that gets a little bit more complicated. So again, if you're making a non-deductible contribution to a traditional IRA, and that means you're sort of above these income ranges, you can do it, but complicated. I'd really encourage you to seek out professional guidance. So that was for if you're single. If you're married, and again, file your taxes joint, as almost every married couple does, the deductibility of your traditional IRA contribution begins to be phased out at $116,000 of annual income, and then is fully eliminated at $136,000 worth of income. Okay. Deep breath. So that's fairly confusing, but if you're married, we have one more test we need to talk about. Sorry for that, but it's just the case. So if you don't have access to a retirement plan at work or otherwise, but your spouse does, then the deductibility of your, again, traditional IRA contribution might be limited, but it will be limited at income thresholds that are going to be a little bit higher. So in this circumstance, again, where you don't have access to a retirement plan, but your spouse does, if your combined income when you file your taxes together is greater than $218,000, your ability to get a deduction for that traditional IRA contribution begins to get phased out. And then once you hit $228,000 of annual income, your ability to deduct that contribution is entirely eliminated. Again, these rules and the math around them is complex. So if you find yourself near these income ranges or in one of these circumstances, I'd really encourage you to consider working with a qualified professional and getting good advice. So, okay, I've just talked a lot. This was a lot of information. It had a lot of numbers in it. I hope that helped clear things up a little bit, but man, I would be surprised if you didn't have more questions about how all this stuff works. Even the simplest retirement plan that we were talking about today, that's the IRA, whether it's a Roth or a traditional IRA, it's still pretty confusing. There's still a lot of rules, and still it's a great way and a great tool to use to save on taxes and to be saving for your future financial independence. If you have any questions about what I've covered or anything else circulating in your financial life, don't hesitate to reach out. You can always find out more about me and contact me at my website. That's turningpointhq.com. So that's all I got for today. Thanks so much for watching and have a great rest of your day.